Hey everyone, and welcome to vlog number 10 of my YouTube channel, Lake Effect Investments. My name is Amir, and what I do over here is talk and discuss the US equities market or the stock market, macroeconomic factors, industry dynamics, sector dynamics, financial markets, or anything else that's kind of top of mind and most relevant to what we're doing over here. And if you'd like to check out my original portfolio investment points and buy points, you can do that in vlog number 2. And as you can see, currently, the general character of the investments is tech heavy. And as I've said before, I kind of avoid the term startup because these are not pure startups. They're kind of like early life. So with high growth potential, hopefully, and usually I look for companies that are working on something that has some breakout value, hopefully, and can provide maximum future returns. So we've got our star performer over here, which is Butterfly Networks. So that's kind of like biomed slash AI. Akebia Therapeutics is drug development. That's kind of one of the sectors that I work with. ARDX is similar. Both are kidney related, chronic kidney disease related. Then you got Navitas Semiconductor, and now we also are jumping into the quantum computing world. I'll talk about that in a minute. But yeah, overall, since I started doing this about 6 months ago, so we're at 170 days. Things are looking pretty good. We are at a net return of almost 40%, so 39.9%. That's over a course of 170 days, so reasonably mature. Before I couldn't really talk about this too much because we didn't have the maturity levels, but now we're definitely getting there. A couple of close positions, so I'll get into more detail with this a little later on. But a quick comparison points. If you look at the NASDAQ um, and its level when we started, which was about August 15, 2024, and what it's done since then, it is at 11.6% plus. We are 3x, 3 times on top of that. And if you want to say, okay, well, NASDAQ is very broad based, right? Yeah, it's tech heavy, but it's small caps, it's mid caps, it's large caps, it's everything. So maybe it's just not the best comparison point. I have been looking for better comparison points, but honestly, don't really see anything that's well established that's going to be very relevant. There is a mid cap, but it's S&P Standard and Poor's, so it's not going to be too tech savvy, I guess. But anyways, other point of comparison that I have is Mag 7, since I've been tracking them, and I think if you're playing in the tech sector in the stock market, you need to know what's going on with Mag 7. Let's look at that. And I have my own Max 7 index, right? Anybody can do this. All you got to do is start a portfolio in Google Finance, pull in the Max 7 stocks, just give it one stock quantity each, and you've got your own index. So from 6 months ago, right, from this level to where they are right now, they are at 24% plus, right? And that's with the Trump trade. That's with the bullishness that came with that, and that's with Tesla and Elon Musk and all that. So we're even beating that. So pretty good. Pretty happy about that. We'll talk more about that in a little while. I want to get started with the usual stuff that I do, which is kind of the overall macro situation, kind of what's coming down the pipe, and what's it's doing to the landscape, to the environs, and the entire risk profile. All right, so let's get started with that. Okay, so top of mind stuff, macro factors, economics, politics, things going on, right? Here's the risk box that I started doing the previous vlog, and I have the previous one down here as well in case you want to reference it and see how things have changed. But what do I got here? Well, we've got tech and AI business cases on the number one spot. So I think you have an idea of what happened over there, but I'll talk through it real quick. So yeah, the a Chinese AI app by the name of DeepSeek dethroned OpenAI's app on Apple's online app store and became the number one app in the world. After several reviewers took a look at it and compared it to OpenAI, they do believe, and US reviewers, that it is at this time the better product to boot. And some of the initial narratives that came out of it, which was the bigger concern, is that the company that made it, or some investigative journalism, thought that they were able to do it with just a 5.6 million, I think that's the number that was floated around, a 5.6 million training run. So that's essentially the cost of this app versus the billions that Western companies like OpenAI, NVIDIA have invested into infrastructure, architecture, as well as building out the models and the algorithms themselves. And now that risk and return, that investment and return equation may be in jeopardy if one of our major competitors has an app that can be produced and commercialized at a fraction of that cost. But that likely didn't sound very true in the early fog of this explosion. And since then, there's been more narratives and more reports around, well, maybe that was not exactly true. Maybe it cost them quite a bit more than that. And maybe that number is something like 500 million. That's another report that I've seen. And they possibly did it with NVIDIA chips that they may have sourced through, I don't know, possibly illegitimate channels through Singapore or something like that. But anyways, it's thrown the entire tech AI world into a flux, and people are asking good questions that, what is the business case? How cheaply and effectively can this technology be developed and commercialized? And what exactly is the AI economy, the AI business case going to look like down the road? Right? So good questions, very good questions. And in the immediate aftermath, there was something along the lines of $1 trillion correction in tech stocks, and Nvidia picked up the lion's share of that, as you can see over here. I think Nvidia's, it's definitely 400 billion lower than where it was with a $3.5 trillion valuation about a week ago or so. So yeah, as I've talked about before, there is large capital expenditures on AI build out, right? It's still going on, and most of the guidance that the Max 7 stocks like Microsoft, Apple is not as AI architecture build out invested as the others are, because they're more of a consumer centric company. Um, I guess that's one of the reasons. But a lot of the other ones, like Facebook, like Microsoft, have given out large expenditure guidance on building out AI in 2025. So all that could potentially change as this demand for clarifying the business case for AI and how effectively it can be produced and commercialized takes center stage. And at this point, we just don't know. We just don't know what that's going to do. Some narratives have come back and said, well, they don't think it's going to fundamentally change what's going on in AI right now, and especially with the whole build out, the whole capital expenditure that's going on. Other voices are saying that it's likely to cause an adjustment and a rethinking. NVIDIA is still lower, so very, very early days. Good thing to keep an eye on. We'll see. We'll see how this progresses. And it could be a good thing for the small cap stocks that's part of our strategy, right? Because there isn't really anything here that I think is going to fundamentally really benefit. Maybe Navitas Semiconductor could benefit from that. I mean, they're more of a semiconductor heavy company, not so chip heavy as far as I know. But still, they're a small cap stock, and they're a pretty good visibility stock, and in a bit of a bullish phase right now, as you can 30% from kind of where we bought it at, but it did go down to about $1.60 as well. So it's come back from those levels about a good 60-70%. So those kind of stocks, mid cap, small cap, could benefit in a situation where You know, everybody everybody doesn't have to go gung ho and say, okay, well, we have to have the Blackwell, NVIDIA, state-of-the-art chips um, to build out a state-of-the-art um, AI data center, and at whatever cost that comes, because we can't afford to be left behind in this race. So anyway, the race is on, and it's hopefully getting rationalized, perhaps a little earlier than we would have expected. So I find this encouraging. I think it's a good correction, and you know, it'll keep things a bit more sane, a bit more leveled, um, instead of just going gung ho after AI expenditure. So, all right, let's, you know, more to come on that, obviously. Okay, so the next big thing is inflation stagflation. Um, and why is that big right now? That's really big right now because of Trump's tariff po policies and his outlook and his statements, right? A lot of which is also very early and very foggy at this point, and it's going to settle down hopefully in the future. But he has been pretty aggressive about it, and supposedly tariffs on Canada and Mexico up to 25% are going into effect starting today, February 1st. But again, when you read into the details, a lot can happen, right? It's not as easy to figure this out or to model this out. A whole bunch of stuff is open to interpretations and open to adjustments and special treatments. So there can be a whole bunch of exemptions that might happen in certain cases. Um, Trade today generally is very complicated, and it is not like what it was 15, 20 years ago, right? It's very complex. There's multiple supply chains, and they route through different countries and different places, and they come together at a different place, and they get manufactured and assembled in a different place. And this is all to get strategic advantages. So it just really is never easy. And I think one of the biggest cases that we're looking at right now, and I'll talk about EVs more detail a little later on. Uh, but you know, with EV manufacturing, so there's a lot of auto industry manufacturing, or I would say raw materials component manufacturing that takes place in Mexico and then gets shipped out here to the U.S. for final assembly and product manufacturing. Well, I don't want to call it manufacturing, I guess assembly and distribution, of basically products that are American products that are essentially effectively being designed and produced here in the US, but where you're sourcing components from other countries, for an effective supply chain process and a cost-effective one. So it's very complicated, and you know, typically with Trump, it's off the cuff. It's kind of rolls out in a more rough manner, but mostly does tend to get settled and rationalized and pushed back um, in subsequent time periods. So hopefully it's not going to be as bad as it sounds right now, but everybody expects it to have some kind of an impact, and we could see inflationary pricing come back. Um, and that is the reason why, or primarily the reason why the Fed did not cut interest rates on its meeting on Wednesday. So there's an interest rate pause here because as tariffs are placed on imports, they can definitely reverberate through the system and show up at the retail level for consumers. But a lot can happen in between now and then as well. So even with tariffs, as corporations, companies are importing raw materials or whatever they're importing, and then processing that and bringing that to the American consumer, there's a lot that can happen in that process as well. They can get more efficient. They can have cost synergies at certain places where they can absorb that tariff. They could absorb it in the pricing as well. There's very different price sensitivity across different products. So, for example, essential products are seen as low price sensitive to the consumer, right? You gotta eat at the end of the day. You gotta buy eggs and milk. So the price sensitivity over there does not necessarily um, warrant a response or a reaction from the consumer. The consumer is probably going to cut back on something else before they cut back on that. Other items, like luxury items, are going to have a huge sensitivity to pricing changes. You could change the price of a Starbucks coffee, and people like myself may not choose to want to spend $6 or $7 on a grande Starbucks chai latte or something like that. So different price sensitivities, and companies will respond to it in different ways according to what they can do and what they can't do. So if it is too sensitive for a company to change its price at the retail level, it's going to look to absorb those tariffs somewhere else within its manufacturing process, right? Because it can't afford to go to the consumer and raise prices 10, 15%, knowing the demand's going to react in a way where it's going to be counterproductive for the company, and it's going to actually going to produce more losses. So they gotta basically absorb that cost somewhere else. So a lot to happen in that area as well. But generally, there is anxiety and fear around that. The Fed has paused cutting interest rates, and they probably want to see what happens to inflationary pricing down the road, and also how much of and how much tariffs are actually rolled out, right? Coming out of kind of the political campaign spectrum and kind of getting into more of a real life on the ground kind of realities. Anyways, I mean, a lot of people have revised their interest rate forecast for 2025. I think some are saying maybe one drop, maybe two drops still, or maybe nothing, no cuts in interest rates. And who knows, if inflation comes back, maybe we even have to see a hike in interest rates. But all that is just purely speculative at this point in time. Um, it does do things like raise bond yields, and bonds are a competitor of stocks. So, if bond yields are high and they're elevated, investors will be more attracted towards that, and it is a bit of a counter to stocks. Um, and then usually, if interest rates are lower, it drives more liquidity, kind of more interest in stocks. But overall, as far as I'm concerned, the interest rate sensitivity, to the stock market and stock market narratives is really overblown. I mean, interest rates are elevated, but they're not stupid crazy. They're at a reasonable level, I would think, and they're not the be all and the end all of what's going to happen in the economy. So we can still do well with reasonable but slightly elevated interest rates. And as you can see, as I just illustrated, the NASDAQ's done pretty well with elevated interest rates. Max 7 has done even better with elevated interest rates, and we have done even better than that, even better than Max 7 with high interest rates. So I don't put too much stock into it. I do realize that it's a huge sensitivity for people, for markets. And then a little something on the positive side. Um, as the economy is rolling along, right, with everything that's going on, interest rates, tariffs, um, plane crashes, tragic, whatnot, there is good news, right? So if we want to take a look at what can give us some good indication about what's going on with the average day-to-day consumer at the base level on the ground, we do have the GDP reports, but they're very high level. General Motors reported record profits, all right, and stronger results in 4Q24. And since they're a very consumer-centric company, and their products and their cars and trucks are sold to the consumer, and people paying out 20, 30, $40,000 for a product, um, is a good sign that the economy is still strong and it is resilient. And further, hopefully you guys can see this. Let me blow. Yuck. Sorry about that. What the heck happened here? Sorry. Let me pause this and fix it. Sorry about that. I think I got it. And then also Apple reported very good earnings, another very consumer-centric company. It's global, but it does have a very significant US market share as well. Them doing better in terms of their fourth quarter 24 results is also a good indication that the consumer is in good shape, the economy is in good shape, and it's pretty resilient. So some good news over there. So consumer confidence deteriorating, that's pretty normal in this situation. One reason that's usually given for lower consumer confidence reports is that even though inflation is tamed, prices are elevated, right? So prices of essentials even went up, and that has put pressure on the consumer as far as cost of living goes. So people aren't too happy about that, and they keep reflecting that in these surveys. But also just the overall uncertainty. We just come out of the campaign. We just got a new administration in. There's a lot going on. There's a lot that's changing. There's policy initiatives, rollbacks, rollouts all over the place. So it is going to create uncertainty, and it's going to be reflected in these surveys. So there's the good, there's the bad, and there's the ugly, and you're going to see this. So, but I would say that for now it appears that things are going well, but everybody's kind of also scared at the same time that something's going to break, something could break, and the house could crash. But I think that likely is not the scenario. And I think a lot of these uncertainties around the Trump policies and changes will hopefully get settled down with time and will get rationalized. Okay, so let's talk about quantum computing. All right. So this is another massive explosion that's taking place in the stock market, and I'll, I'll I'll run through a little bit of ABC on this, but just to kind of give you an indication of the level of interest. So, since I'm now a quantum computing investor, um, I've got this portfolio set up and tracking a bunch of companies over here, looking through stuff. But let's look at Rigetti's trading volume, right? So wow, 200 million stocks in trading volume. Pick Ionique. That's big on visibility. Um, but not as big on trading volume, right? But the price level is much higher. Maybe that has something to do with it. Anyways, 40 million over there. And let's take a look at the one that I actually ended up buying. So wow, 100 million plus. All right. So definitely, yeah, huge interest in these stocks. So what are computing and quantum computers? And I'm going to talk a little bit more about this because I actually have read about this some time back. Not quantum computing itself, but read some stuff on quantum physics. And basically, quantum computers, right? They process and calculate in a way that is fundamentally pretty different from what computers do today. So, right? So computers today, as I think everybody knows, use a binary source code, right? So binary just means zeros and ones. Zero, no electric current. One, electric current. So a charge is a one, no charge is a zero. And that's the basic architecture that they have to work with. Quantum computers take a huge step up from that, right? And they work with something, so instead of working with a binary zero and a binary one, they work with something called qubits, right? And you can have multiple qubits, and that obviously gives you a much bigger combination mathematically to work with, right? Rather than just zeros and ones. So apparently, conceptually, you can do a lot more in terms of calculation that you can do with a conventional computer. Now, I don't understand a lot about this, right? Except for these basic concepts. But what I do know is that the concept of qubits, right, which with superpositioning, which means that apparently this code or this qubit can have several positions at the same time, and it's called superpositioning. and it can denote different values at the same time too. So I don't know exactly how it's working in quantum computers, but basically the experiment or the idea that this is based off, and it's not just an idea, so it's a real quantum thing. But that's what people mostly don't know about, um, is the background, and that how much of that is theory, how much of that is fluff, and how much of that is real. So it is pretty real, and where it comes from is that in physics they run these experiments, and I think when I read this book several years back, it was called God and the New Physics, by an author named Paul Davies, an Australian scientist. Very good book, definitely recommend it. Um, and where I was going with this, oh yeah, oh yeah, oh yeah, is that with John Wheeler, right? And this experiment that they had, um, what they'll do is they'll shoot these atomic particles or subatomic particles, through these massive accelerators. Some of you guys may have seen that stuff in CERN, Switzerland, where they have this accelerator that goes on for miles and miles and miles, and they smash these particles, these atoms, into things, into walls, into other barrels and things, and see what happens, right? See what comes out and what these subatomic particles look like and stuff like that. So in this particular experiment, I think they did something like that, right? They would shoot the particle into a barrel, and on the other side, they would have like 3 or 4 barrels where it could possibly come out of, right? And then when you go to the other side to see where it would come out, it would always show up where you would look for it, right? So I don't know if you had 3 barrels, 3 output channels, or 6 or 7, it would always show up where you would look for it. So that's something to do with observation, of course, right? The particle shows up where you observe it. And there's all kinds of interesting universal cosmic ideas built off that. But that part is real. So it leads scientists to believe, okay, there's at least this part may be theoretical. There's several positions where the particle is existing, but it'll manifest itself where you observe it. So that leads to that superpositioning idea in quantum computers, and that's kind of what they're based, what their I guess their chip architecture is based off. So Google released this Willow chip, based on this qubits, and what it was able to do was to solve a specific problem, right? Um, and I'll get into in a minute why I say specific. Within 5 minutes, that would take a conventional computer something like 10 septillion years, which is a ridiculous number. It's older than the age of the universe itself, apparently. And when it was able to do that, quantum stocks skyrocketed. So we can see that. Let's go back. You're gonna see that over here. Over here, yeah. So this was kind of where that happened. So huge pickup, right, in these stocks, and then what happened was that Jensen Huang, the CEO of NVIDIA, and a little bit later on Mark Zuckerberg of Facebook, they commented on the quantum computer idea, since these guys are at the forefront of the tech breakout right now, especially the AI breakout, saying that useful quantum computers are still about maybe a decade to 2 decades away, and there's a lot that has to be worked out in quantum computers before they are useful and applicable. So there's stuff like error rates, and other issues that still have to be resolved. So apparently the speculative bubble burst at that point in time. It definitely had a pretty strong reaction, I remember. And here's kind of the crash in these quantum stocks. And then basically a bit of a lift out of that. So what happened in the immediate aftermath of these comments by Messrs. Huang and Zuckerberg is that other industry leaders, and the CEOs of these companies that already have quantum computing publicly listed stocks, pushed back, and basically, I think the narrative that they came out with a yes, in one sense, a full-fledged, comprehensive, or independent quantum computer is still a long way out, but there are a lot of quantum concepts and applications that are already in use, and they have business case applications that could see pretty robust development over the next few years or so. So one article in particular, I'll just show it if I still have it here. Yeah, this one was pretty good. So you guys can go to Forbes and read through it if you want to do that. It's by Jason Snyder. So it talked about the quantum companies that are working today, the business cases that they're working on, the kinds of things that they're doing. And there's hybrid systems, there's quantum sections of a computing processing scenario where you can use these, and they are supposedly pretty effective. So he also put forth a few cases in this article where he thinks that quantum computing is going to be pretty relevant. So good article. It has specific use cases. It mentions specific companies and the kind of things that they're doing in the business today. So it was a big pushback on basically these top line comments by the bigwigs, and I think with good logic and some good substance as well. And I think I don't know if this article had anything to do with it, but I think overall there was a pushback on those statements, and it seemed to have worked. And the areas that most of these folks are talking about where this development can take place is basically, first of all, AI. Drug development is a big area where AI is generally expected to make some improvements, and that's one of the big business cases. But where quantum computers and quantum systems with very advanced calculation prowess can make a big impact. Weather forecasting and live marketing campaigns is a pretty interesting one. So if a corporation wanted to do a global campaign that's, let's say, worth about $100 million or so, today with conventional computers, they got to plan in advance. They're going to do budget allocations. They're going to work on advertising, a bunch of whole other channels. They'll target specific markets, and they'll look at response levels, or anticipated expected response levels, and allocate their efforts and their energy and their dollars that way. But what a quantum computer could do potentially is do all that in live mode. So it can probably look at how consumers are responding to an advertising campaign in a particular area, and if that's turning out to be better than expected, it can reallocate resources and budgets and things to that more quickly and in live mode, and be able to multitask a lot of things. This whole idea with qubits and superpositioning is that quantum computers will be able to multitask in a way that conventional computers cannot today. So there was that whole multitasking aspect that was explained, and it seems to make sense. Anyways, after about a good 2 to 3 weeks of some pretty deep diving into this and reading it, and to come away with as much as you can at this point in time, which is pretty early on, it looks like quantum computers is definitely going to be a thing in the future, right? And maybe even a 2025 things. And you're going to see all kinds of narratives, right? Even with the current pricing levels, which are not as elevated as they were, it's still high, right? It's still pretty high, and you're gonna have narratives where these stocks could plunge, lose value 50%, 60%, 70% if things don't develop the way that we want them to develop. And on the other side, uh, stocks could soar. This could be the next big thing. And one of the scenarios that could unfold with this is that we could be in a sort of a race-like scenario, right? So something in 2024 with 2023, 24 with AI, where a technology is just seen as so central, so key to future success and future power play and prowess, that investing in it and going after it in a big way to make sure that you reach those milestones just becomes a top priority. And in that situation, definitely the values of these stocks can be exponentially higher. And then, as the cycle goes, at a later stage, the business case tends to come out. And you're going to see that. You're going to see that with these stocks because even if you do a very rudimentary analysis on what ratios and metrics you can even look at with these stocks, it's going to be crazy, right? So price to sales, um, yeah, price to sales ratio. We can't look at profit because these companies aren't very profitable. So here's revenue, here's sales, right, from 4Q23 to 3Q, so a full 12 months for all these companies. So you can see some of them are making sales. They've got some business rollout, and their value, right? So the company only has $10 million in sales in a whole year, yet it's worth 1.8 billion, and this one is, you know, 7 times that much. So these ratios of 186 times sales in terms of valuation is crazy, but it's normal for this kind of a scenario. That's what's going to happen over here. You're going to see these very, very crazy. And look at Quantum, right? Because they hardly do any revenue and they're still worth 1.2 billion. Their price to sales multiple is 3,050. These others are typically more or less in the space that you would expect them to be. So what's basically the market is saying, right? It's not saying that, hey, we're all going to give these guys crazy valuations because of the very promising future in quantum computing, but eventually we expect the revenue numbers to come up, right? These are going to come up in a pretty big way, hopefully, and it's going to start normalizing this ratio. But um, but valuations can still increase from this point on. And in these initial stages, even if we stay with these ratios, even if the prices go higher, revenue doesn't track as quickly as we would like it to. Yeah, expect these could go higher as well. And the downside risk is pretty real too. Although I'm not as fearful of it because given the research, given the rollout by Google with the Willow chip, given everything that I've read so far, and given what these quantum computing companies are doing, it definitely looks like that it's going to be a thing. At a time like this, it's got to be a long-term hold, and yeah, you can expect your stock to go down. Hopefully, not more than 50%, but even a downside of 50% is something you have to be willing to live with, and have at least, I would say, at least a 2-year outlook with this stuff. So quantum computing. Welcome to quantum computing. It's a part of our portfolio, and we'll have lots of fun discussions around that in the future as well. All right. To wrap up on quantum computing, here is an article by The Motley Fool. You're gonna find articles all over the place, but I'll tell you, most of the narrative has been positive around it. I haven't seen too many of these guys that these stocks can plunge, and that's a Motley Fool article too. Uh, but yeah, this is one that's also very positive about the D-Wave quantum stock that I picked up. But there definitely is a lot of talk about it being um, a strong trend for 2025. So let's see what happens with that. Anyways, let's move on to EVs, electric vehicles. I always talk about this because it's a segment that I've been following for quite some time. Made an investment in it, which for the time being didn't turn out too well. And I'll talk about that in a minute when we get into the portfolio. But I still have some vested interest in it. I'm still looking to maybe get back into it in a bigger way. And the reason for the bullish sentiment, despite the current stress that the sector is going through, is primarily because, as I've talked about before, the USA market share is just at 8%, so it's still very low. and compared to Europe and China, it's very, very low. So we think it's got to come up. We think the momentum is there, the base is there, the early adoption has happened, and hopefully we'll see another more robust wave of growth and adoption sometime over the next couple of years or so. And despite everything that's going on, so basically the current narrative is filled with this whole Trump's war and his repealing of all the Biden era mandates around EVs. So got to reach this milestone, got to reach that milestone with EVs. So he's rolling all that back. He's supposedly taking away the tax credits. We don't know for sure if he's going to be able to do that. I think congressmen need to ratify that. And any other government incentives, going with the argument that the industry has to take care of this stuff on its own, right? You can't have a subsidized industry in the marketplace for too long. And if EVs are the future, EVs got to show us that they're the future, and they got to show us on their own. So it's a good argument, and a lot of people are pretty risk conscious with EV stocks right now, and they're definitely taking a hammering. But the overall situation at a fundamental level is pretty good. And the reason for that, and this is a good article if you wanna check this out by Patrick George. It is in a biased block, which is Inside EVs. But I think the argument is pretty solid. If you look at some of these bullet points, 1.5 million units sold in the US, estimated 2024. 1 out of 12 cars is now fully electric. We've had the world's premier pioneer and producer of EVs, which is Tesla. And I think most important of all, there's about a good 100 billion of build out of battery electric vehicles and battery factories that's going on right now. So there's substantial investment in the US based on future EV demand. So I think that the overall outlook is pretty good. It's pretty strong, and it's pretty well supported by facts on the ground as well. And I think that if we were just to quickly revisit, fundamentally, do EVs make more sense? Are they more effective? Are they more cost effective and maintenance friendly than ICE internal combustion engine vehicles? Look at a few points over here. Greener footprint, less reliant on imported fuel. That was a big narrative a few years ago, not as big right now. There's been counter narratives on the fossil fuel input in production of the batteries for these cars, but at least from a maintenance perspective, once they're made and sold, they don't consume gas after that, right? So it should be greener. Fundamental efficiency, ICE versus BEV. So internal combustion engine, on the plus side, you don't have the intakes to create that energy and power in the vehicle. So an ICE system is taking in fuels, taking in air. That's another intake. It's producing the combustion within the engine itself, and then there's an exhaust system that needs to go with that. So you're getting rid of all that, and that should lead to better efficiency and better maintenance. But at the same time, on the minus side, EVs do have expensive tech systems, electronic systems in there. They have higher repair costs when these systems get damaged or there's a collision or something like that. There's higher insurance costs. If you research this stuff, this is typically the stuff that I'm coming across. There's range anxiety and charger networks. So all that definitely sounds right and sounds real. But this is all pre-large scale, right? So insurance costs, repair costs, maintenance costs, tech systems, all these things are going to get pulled into economies of scale once the scale goes up, right? So it'll be more effective for insurance companies to be able to insure these cars once they're doing it large scale. Repair shops can do it more cheaply if they have more business to go after. And same thing with tech systems. And I think also one key point is we're very early. We're still very early. We're kind of like really only in year 5. So we can expect a lot of improvements, battery improvements, electronic system improvements, other kinds of improvements, charging, range, all that stuff is, I think, still coming down the road. So Eventually, it'll have a better fundamental profile than ICE vehicles. I still don't think ICE vehicles should go away. I think it's good to have a diversified fuel source. But anyways, the longer term outlook is still fundamentally good. And then with this point with the global tech race, I mean, hopefully the Trump administration comes around a little bit to this. Subsidies are not a bad thing, not all bad. There are definitely a lot of subsidies in Europe and especially in China. I'm sure the government is subsidizing production over there substantially, even though they probably need to do it a lot less now because they have so much of a bigger market over there. But maybe this comes around since the Trump administration is very science friendly and tech friendly and wants the U.S. to have kind of the upper hand in these technologies in the future. Battery technology's got to have a lot that's coming down the road. There's just a lot of stuff, a lot of developments and innovations that are hopefully going to improve battery range. So stuff like solid state batteries. Honda's working on a huge research project that they've kind of signaled is about 2 to 3 years out, but that's going to make a huge dent in battery efficiency and range. So a lot of, and then stuff like robo taxis, right? All the stuff that Tesla's talking about, automation. So a lot of technological advancements still coming down the road, and we don't want to get left behind in it. So at the end of the day, the subsidization isn't really all bad. And hopefully the Trump administration comes around to it and sees the light that, stressing this sector at this point in time is maybe not the best thing for the U.S. And for our own hold and grasp of this technology, which at this point the narrative is that China has the better model and game to boot with EVs, and now apparently they're also kind of taken over with AI um, assistance. So maybe more of a reason to stay tech savvy and to actually support and bolster the industry rather than try and tackle it the way it's shaping out. But again, very early days. Let's see what happens, right? At least I think in this article, Patrick George was of the opinion that a lot of what's being said is likely not going to pan out in that way. But so bumpy, yeah, definitely very bumpy right now. But definitely good long-term prospects, and I think a very good investment opportunities, specifically given the fact that the sector itself is pretty stressed right now. So if we take a quick look, let's go to EVs. Okay, so this is my EV index, you can call it. Same thing as the quantum index concept or the Max 7 index. And I have a bunch of EV stocks over here, I think, which is pretty reflective of what's going on. And it's a very good price point. It's an excellent price point. EV growth was supercharged in this area, and then it kind of, after supposedly the early adoption wave was over, it's kind of flatlined, and a lot of those very crazy valuations have rationalized, and a lot of these EV stocks are at like 90% lower from their peaks, 90 to 95%. So I think the long-term opportunity in EV is still very strong, and we'll definitely keep a close eye on this industry, and maybe jump back into it in a bigger way, maybe a little later on in this year. All right, folks, let's move on to the last section and run down our portfolio of investments over here. So, yeah, just like I mentioned at the beginning, very nice, very nice. We're at 40%. We're beating the NASDAQ by 3 times over, and the Max 7 by almost twice over. All right, 1.8x. So I think definitely, and we've done it over 170 days. So pretty good, getting mature. A couple of things about this format over here in this data, since I've made a couple of changes and I've shared this many times before. So we definitely have this closed box, right? Because I sold out a couple of positions. These were basically the two loser stocks in the portfolio. I've already talked about BNGO before, so I'm not going to get into that. But I guess really basically they're having a hard time. They're not pushing their OGM, optical genome mapping system, into the market as aggressively as they were before, since they have a pushback from the market. The systems are expensive to install. Capital expenditures are at a shy at this point in time, generally in the medical industry. So they're working more on adoption and basically deepening of their existing customer relationships and stuff like that. So not the most robust strategic outlook that you would be looking for. So the exit was a little bit timely. I guess it could have been more timely, but I think the stock's now down to 21 cents or 20 cents. It actually has done a reverse split, so it's at a different pricing level now altogether. But anyways, moving on, right? So Blink Charging is an EV stock. It's I'm pretty gung ho in the EV industry, and I exited this one because it is producing. It's a bit of a loss producer for the portfolio, even though it's probably okay as a long-term hold. But I kind of wanted to recalibrate, kind of relook into things in terms of the EV investment. We still have Navitas Semiconductor is still considered by some in the market as a bit of an EV stock because they do a lot of manufacturing of systems and components for EVs and other energy-related electric component kind of products. But it is touted as a bit of an EV stock as well. So I'm still in the industry, but Blink also was kind of coming up short in some analysis and stuff. So like I have over here, I was kind of comparing it to ChargePoint and to EVgo, and its financials are not in the healthiest of states, and it was definitely the worst out of these three. So this ratio over here, P&L to revenue, like I've talked about before, that's the one that you look at for with these stocks that are not turning a profit at this point in time. And they're kind of the worst, right? Their losses versus their sales out of these three at minus 1.32, and third quarter was kind of a bit of a leader in that metric, was minus 3.5. So given all that, I got to respond to fundamentals. I got to respond to whatever research I'm doing. I don't know exactly what's going to happen in the future, but if I do get back into a charging stock, it might be ChargePoint. EVgo is a good looking stock, except for the fact that its valuation is already at $1 billion, which means that its value to revenue, this is P&L to revenue, and this is valuation to revenue, is already at 4x, right? Whereas for these stocks, it's at 1x. ChargePoint may be the one to go with, or maybe I pick up Rivian this time, right? A direct EV stock, and with Mr. Scarnett staring me down over here. What are you gonna pick? When are you gonna buy some Rivian stock? I might just do that. So the thing with the EV industry right now is that it's in a little bit of a stress. It's a little bit of an uncertain waters, so it's not going anywhere fast. I would look for it to come out of its current turbulent waters, maybe in late 2Q, maybe early 3Q, something like that. Could be a second half 25 thing. So it gives us time. It gives us time to think about it, to do some more analysis, and maybe sharpen our pointers in terms of exactly what we want to do. And maybe it is Rivian. So it's not the quantum computing thing where at least I felt that the decision has to be made on that kind of more today rather than a tomorrow, because it's kind of in that phase that EVs were back in 2022 and 2021, where they were skyrocketing. Is that the future could be awesome, and let's price that in, right? Let's value that in, and let's give everybody a crazy valuation or something like that. Not that that's what I want to see happen with quantum computing, or that's how I want to make my my forte, my success over here. but it is something that can happen over there. So since you don't want to miss those pricing levels, um, I thought that was more of a today thing, and I want to kind of reallocate some of the portfolio into QBTS or quantum computing, and that meant, unfortunately, or fortunately, an exit for Blink. But maybe we look to bring either Blink or somebody else back in a little later in 2025, because looks like we probably do have the time to do that. But other than that, like I said, the portfolio is doing great. I mean, our star performer is Butterfly. Hopefully, it says that because it's carrying the show. It's carrying the day. But very good contributions from Akebia Therapeutics, chronic kidney disease drug development over there. They're doing pretty well, and I kind of expect them to do better. A lot of analysts have re-evaluated their price targets for Akebia, and they are quite a bit higher. I think the highest one right now is $7. Navitas Semiconductor doing pretty good at 30%. It's been really up and down, so it's been as high as $4. But it's still giving us a 30% and giving us a pretty good return. And maybe with the current commotions in the overall AI chip semiconductor space, with terms of what's going on with DeepSeek, and really what is the right future for NVIDIA, where it's going to land, maybe all that, it could play into favor for small cap semiconductor stocks like Navitas. So definitely keeping that position. Hopefully good things with quantum computing coming up. Um, and ARDX, I think I talked about that in the previous vlog. So we had a retraction in ARDX because one of the legal cases that I think ARDX had filed against CMS, which is the Center for Medicaid and Medicaid Services, so that their medications for, I think it was Foza for chronic kidney disease, is not bundled into the Medicaid and Medi-Cal packages, and that will affect the strategy for the company, its marketing strategy, its pricing strategy. So that upset caused its price level to drop, but it's a good fundamental company. It has strong fundamentals. The drugs are doing very well. Sales are increasing. So I think that's going to be a bit of a smaller setback for it eventually, and it's going to come back stronger. And then we also have the pending Kidney Patient Act that is still pending somewhere in Congress. It has bipartisan support in the past, but it still, I think, has to go through both houses of Congress before it gets passed. And that's supposed to be a big boost for ARDX. So I think we're holding on to ARDX for now. And I even expect it to do well with 4Q24 results. And hopefully that'll assuage some of the anxieties and the fears of the investors that how dislocated it's going to get with that court case verdict that came against it. But yeah, that's definitely, I think, hold on to that one for now. The only other thing really quick to end on is that since the portfolio now is fairly it's a little bit aged, I guess, compared to what it used to be. 170 days, that's since August 15th. So I have that up over here. So now I have to day weight my position, day weight my gains, which means basically I'm giving it a weightage. Since I'm gonna do that over here, so it doesn't make it too busy, and people don't need to concern themselves with this too much. But basically, if you've been on, so since Butterfly's been there since day one, 170, everything's going to be the same over there with day weights, right? But for other stocks that were picked up a little later, you'll see slightly lesser when you do it times 155 divided by 170, so it's day weighted. But for example, the reason I got to do this is because D-Wave Computing is in there, the quantum computing stock, and that's only a few days old. So over here, this is going to have marginal impact on the metric performance numbers, right? I don't want to put QBTS in there, and just because it went up a little bit, 5%, this 5% doesn't really factor much into this 67%, because it's weighted out, because it's only been there for 3 days. But as time goes on, it'll factor in more, and that basically is the idea behind all that math. But I'll just keep that out of sight, bore you guys with that. But with the weightage in there, all the day waste and everything. Very nice. Thank you, Birdfly, for being close to 70%, and being 40% on the overall portfolio. So hopefully that sticks, right? Or even gets better. But we shall see. All right, folks, that is a wrap for today. And see you guys, I don't know, sometime over the next couple of weeks or so, hopefully. All right, take care.